Hello guys, today we're gonna talk about systemic risk versus systematic risk and what's the difference, and about low risk and high risk, the difference. Systemic risk versus systematic risk, an overview. Systemic risk describes an event that can spark a major collapse in a specific industry or the broader economy. Systematic risk is the pervasive, far-reaching, perpetual market risk that reflects a variety of troubling factors. Systemic risk is often a complete exogenous shock to the system, such as the threat that one of the major banks that collapsed during the 2008 financial crisis could then trigger a massive market implosion. Systematic risk is the overall day-to-day ongoing risk that can be caused by a combination of factors, including the economy, interest rates, geopolitical issues, corporate health, and other factors. Systematic risk is harder to quantify and harder to predict, whereas systematic risk is more quantifiable and can be anticipated in some cases. What is systematic risk in all? Systematic risk represents the risk connected to the complete failure of a business, a sector, an industry, a financial institution, or the overall economy. It can also be used to describe small specific problems, such as the security flaws for a bank account or website user information. Bigger, wider-reaching issues include a broad economic crisis sparked by a collapse in the financial system. I'm sorry. I saw. The word systemic itself is mainly used to describe a specific health-related issue that affects a person's entire body. This description has then been borrowed to explain why smaller financial issues can dangerously impact the economy or financial system. Systematic risk. While systemic risk is a bit amorphous, systematic risk has a more common meaning. The term is often used interchangeably with market risk and means the danger that is baked into the overall market that can be resolved by diversifying your portfolio or holdings. Broad market risk can be caused by recessions, periods of economic weakness, wars, rising or stagnating interest rates, uh, fluctuations in currencies or commodity prices, among other big picture issues, while systematic risk can be knocked out with a different asset allocation strategy. It can be managed. The market risk that is firm or industry specific and is fixable is called unsystematic or idiosyncratic risk. With systematic risk, diversification won't help. This is because the risks are much broader than one sector or company. The word systematic implies a planned, step-by-step approach to a problem or issue. Investors hoping to mitigate the risks of systematic risk can make sure that their portfolios include a variety of asset classes such as equities, fixed income, and cash, and real estate, because each of these will react differently to a major systematic change. Systemic risk versus systematic risk in examples. The collapse of Lehman Brothers Holding Incorporation in 2008 is an example of systematic risk. After the global financial services firm filed for bankruptcy, shockwaves were felt through the entire financial system and the economy. Because Lehman Brothers was a large company and deeply ingrained within the economy, its collapse resulted in a domino effect that generated a major risk to the global financial system. The Great Recession of the late 20s is an example of systematic risk. Anyone who's invested in the market in 2018 saw the values of their investments change drastically from this economic event. This recession affected asset classes in different ways. Riskier securities were sold off in large quantities, while simple assets such as US Treasury securities increased their value. Okay, this is the first part of our topic. The second will be about low risk and high risk investments. So, low risk versus high risk investments and review. Risk is absolutely fundamental to investing. No discussion of returns or performance is meaningful without at least some mention of the risk involved. The trouble for new investors through is figuring out just where risk really lies and what the differences are between low risk and high risk. Given how fundamental risk is to investments, many new investors assume that it is a well-defined and quantifiable idea. Unfortunately, it's not. Bizarre as it may sound, there is still no real agreement on what risk means or how it should be measured. Academics have often tried to use volatility as a proxy for risk. To a certain extent, this makes perfect sense. Volatility is a measure of how much a given number can vary over time. The wider the range of possibilities, the more likely some of those possibilities will be bad. Better yet, volatility is relatively easy to measure. Unfortunately, volatility is flubbed as a measure of a risk. While it's true that a more volatile stock or bond exposes the owner to a wider range of possible outcomes, it does not necessarily affect the likelihood of these outcomes. In many respects, volatility is more like the turbulence a passenger experiences on an airplane, unpleasant perhaps, but not really bearing much of a relationship to the likelihood of crash. A better way to think of a risk is the possibility or probability of an asset experiencing a permanent loss of value or below expectation performance. If an investor buys an asset um, expecting a 10% return, the likelihood that the return will be below 10% is the risk of this investment. What this also means is that underperformance relative to an index is not necessarily a risk. If an investor buys an asset within the expectation that it will return 7% and it returns 8, the fact that the S&P 500 returned 10% is largely irrelevant. High risk investment. A high risk investment is one of for which there is either a large percentage chance of loss of capital or underperformance or a relatively high chance of devastating loss. The first of this is intuitive, if subjective. If you were told there is a 50-50 chance that your investment will earn you expected return, you may find that quick risk. If you were told that there is 95% chance that the investment will not earn your expected return, almost everybody will agree that it is risky. The second half, though, is the one that many investors neglect to consider. To illustrate it, take for example car and airplane crashes. In 2019, National Safety Council analysis told us that a person's lifetime odds of dying from any initial cause have risen to 1 in 25, up from odds of 1 in 30 in 2004. However, the odds of dying in a car crash are only 1 of 107, while the odds of dying after being struck by lightning are minuscule 1 in 100,000. What this means for investor is that they must consider both the likelihood and the magnitude of better outcomes. Okay guys, it's all for now. See you in my next videos.